Welcome back. You're watching The Money Show with me, Kavita Thaplial, and there are plethora of funds available in the market to invest your hard-earned money. But how do you assess which is the right fund for your portfolio? What are the criteria that one should look at to help you navigate through this maze? We have on board Arnab Pandya, founder Money Edu School. Also, do not forget to send us your portfolio queries on our WhatsApp number, which is 865-797-4571. You can also email us your queries on themoneyshow@etnow.tv. So that's the WhatsApp number and email ID. But good evening, Arnab. Welcome to the show. We have Lalit Mehra's question for you. And so he's been doing SIP every month in HDFC Midcap Opportunity and Kotak Emerging Equity Fund, 5,000 each. And his investment time horizon is 15 to 20 years. He wants to understand if he should be adding more funds in the portfolio. Unfortunately, we don't have Lalit on the phone line, so then we could have asked him more questions related to his goals and the kind of corpus he wants to accumulate through these funds. But talking about the selection, you think he can diversify more?
Good evening. So, if you look at Lalit's portfolio, there are two funds in there, and both of them are mid-cap funds. So, HDFC Mid-Cap Opportunities as well as Kotak Emerging Equities, both are focused on the mid-cap space itself. So, if this is the entire portfolio, then you can see that the 100% is in mid-caps, which is not a viable option for any person because it increases your risk unnecessarily, and any balanced portfolio needs a mixture of exposure across large, mid and small caps so that there is stability in the portfolio. At the same time, there is scope for growth. Now, Lalit's time horizon is 15 years. So obviously, having an all equity portfolio is the way in which he can manage it. But that doesn't mean that the portfolio should not have the required amount of internal balance across market caps. So definitely more funds need to be added. Specifically, large cap or flexi cap can be added immediately. Later on, a small cap can also be added so that there is an equitable balance there. And there is one also no need to continue with two mid-cap funds which are already being invested into. A part of that money can be diverted to the large and the flexi cap.
All right. We move on. We have Rajiv Bhargava on phone line with us. Hi, Rajiv. How are you doing?
Hi. Yeah, I'm good, man.
All right. So you have just invested in one fund, or this particular fund is something that you want to come out of because of non-performance, UTI Flexi Cap, I believe. Okay.
Yeah, I just wanted to know the feature of this fund because I have invested around a year and a half back.
Okay.
And the performance has been very, very poor. So I just wanted to know feature of this. What? Should I hold it for some time or should I come out?
Do you have more funds in your portfolio?
Yes.
Okay, and which are? If you can just name them.
There is a Mira Asset, there is a...
Which fund of Mira Asset?
Large cap.
Okay.
Then many other funds are, right now I don't have the list actually.
Mm-hmm. Okay. Yeah. All right. Although it makes sense to, know your entire portfolio and then suggest an exit strategy from a particular fund. But then, Arnab, how can we help Rajiv? UTI Flexi Cap is something that he's not happy with and invested almost 1.5 years back. Do you think we can give more time to this particular fund, or this is a non-performer in this category?
So if we look at the fund UTI Flexi Cap, it belongs to the Flexi Cap category, which means that the fund manager has the ability or he has the choice to invest across market caps. If you actually look at the kind of exposure that the fund has taken, then it is predominantly large cap with a significant portion of around 30% being in mid caps also, while the small cap exposure is very small. So sector wise, if you go on to look at it, financials are at the top, followed by technology. And what is significant is that the fund has good holdings, at least as far as its portfolio construction is concerned. But these holdings have not performed well over the last 1.5 years, which is why you see that there is a significant amount of underperformance. I think the 1 year negative return for the fund is in double digits, while if you look at the category average, I think it's just -2 or 3% as a whole. But the problem goes slightly deeper in the sense that even if you look at a 3-year time horizon, while the fund has given returns, it is still underperforming the category. So my choice would be that, I mean, since there are already other funds in the portfolio, it's not like that this is the only one there. One can exit from this fund and if required, choose either another flexi cap fund or allocate the money elsewhere. Because not just because the investor has seen a negative return over the 1 year, but also because of the fact that not just one, but even over a 3-year time period, this has not been able to perform as expected.
What about adding other flexi cap? What fund would that be?
So if there is no exposure to say a value oriented theme, then a Parag Parikh flexi cap can be a good choice. Otherwise, if you want to go for a normal traditional kind of flexi cap fund from a big fund house, then HDFC flexi cap is also a good option to look at.
All right, we move on and we'll take Tirthankar Das's question, and he's invested in Mirae Asset Emerging Blue Chip, but he's not happy with the fund's performance and he wants to understand if he can shift to any other fund.
So again, here, I mean, see, one has to always put an investment in context of the overall situation and also the time period for which one is investing in. If you look at the overall market conditions in the last 1.5 years, one can clearly see that there has been tough times, not only just for pure equity as an asset class, but also within the asset class, large caps, mid caps, everything has suffered a bit. Now, Mirae Asset Emerging Blue Chip is actually a fund which invests both into large and mid cap. So it's a large and mid cap category fund. And if you look at it, in the last 1 year, it is slightly on a negative, it is showing a slightly negative return, but it's not a bad performer. So in that sense, if you look at it consistently over a longer time period, it has been a significant outperformer. And just because it has a negative return over 1 year, I don't think that there is a need to change this fund in the portfolio. More time should be given, and you should look at it over at least a 3-year time horizon to see if it is recovering, or if that after that period, if the underperformance continues, then one can look at changing it.
All right, we move on to Vijay's question, and he's invested in Franklin India Blue Chip, Bandhan Core Equity, HDFC Focused Equity, ICICI Pru Focused Equity, and he's doing total SIP amount is 10,000. He's doing SIP of 10,000 in each fund. His goal is to achieve 1 crore in 10 years. He wants to understand the fund mix and the portfolio so far laid down for this particular goal.
So if you look at the portfolio, see, in terms of number of funds, 4 is a good number. It's a good enough number, even though the amount invested is 40,000. But if you look at the kind of choice in terms of the funds, one can see that there is, by the nature of the funds which have been chosen, there is an increase in the risk. So my choice would be that instead of going in for these kind of focused funds or very narrow funds, one should actually look at slightly more broad-based funds in the portfolio. So in this case, my choice would be that remove the investment from 2 of the existing funds, which is one is that the Bandhan Core Equity Fund and the other is the ICICI Pru Focus Fund. Shift it to a flexi cap and a mid cap fund. So where the flexi cap could be something like a Parag Parikh flexi cap, which we talked about, and a mid cap fund could be something like an Kotak Emerging Equities. So if you do that, then there is a better distribution of the exposure within the portfolio, and that I think is a better way or a better strategy to go about it, because just having more funds is is just not the only factor. One should also look at how these funds are structured, where they are investing, what is the kind of concentration risk which is in them, and then create an entire portfolio.
We have Anurag Yadav online with us. Hi Anurag, how are you doing?
I'm doing good. Thank you very much.
Thank you so much for sending us your query. We have Arnav Pandya who will sort out your portfolio today, and you are doing SIP of 1 lakh a month. You've got Quant Small Cap and you have PPFS Flexi Cap, right?
Yes.
Okay. Apart from that, you have lined up your goals as well. Anything else you want to add in your portfolio or the question?
Not really. The main question was whether these funds will meet my goal or not. And I just have, I plan to invest only for next 10 years.
Sure.
And then after 6 years, every 4 years, I will have to withdraw certain amount of money.
Sure. Okay. So Arnav, let's take his question goals wise. What should we start with?
So I mean, see, the goals come every few years, and rupees 30 lakhs needs to be uh, taken out for the goals. Now, if you look at the total amount which is being invested today, 1 lakh per month, and if that is continued for the entire duration for which the goals are there, then achieving the goals is not going to be a problem. But here the thing is that after 10 years, if the investment stops and then the withdrawals continue, in that sense, there is no addition to the corpus, and at the same time, that corpus also keeps reducing. If that happens, then the achievement of the later goals will most probably not be possible, because the corpus would not be big enough to sustain those kind of withdrawals over that longer time period, because there are not just 1 or 2 withdrawals. I think there are 4 withdrawals which are planned. So in that sense, stopping after 10 years could lead to a problems in the later goal. So that question needs to be reviewed. The second point is that, see, the expectation here is that an average rate of return of 15%, which I think is a bit on the higher side. One should be a bit conservative and plan using a slightly lower rate of return, which could be around 12%. Now, if you get a higher rate and you achieve your goals easily, that's a bonus. But one should not expect the 15% rate and bring that thing down. The third thing is that if you look at the existing portfolio and the funds which have been selected, there are only 2 funds. And out of that, 80% of the amount, and which is a large amount, 80,000 per month, is going to just one particular fund, which is the Parag Parikh Flexi Cap Fund. So this is not a good strategy, because there can be times when a particular fund doesn't perform even though the overall markets are doing well. And which is why we always say that in your portfolio, have at least 4 or 5 funds across various market caps. So at least there is some diversification where you have an opportunity where something is performing. So the idea should be that reduce this kind of excessive exposure to a single fund, add something like a mid cap fund, a large and mid cap fund, or even a pure large cap fund to the mix, which will then broaden the portfolio, and you can have funds across various fund houses also, which will give you a diversification across the style of management also, and which will be a better option.
All right. Anything else that you want to know from us?
Just one last question.
Sure.
Should I add a flexi cap then? In addition to the Parag flexi cap, should I have like HDFC flexi cap? I see that it's rated at the top these days.
Sure. Arnav, one more flexi cap? Should he add?
No, my choice would not be to add one more flexi cap, and that to HDFC flexi cap just because it's doing well. I mean, you can go for a large and mid cap fund and a pure large cap fund also, where you can even look at a passive fund. Because what will happen is that, see, a flexi cap fund, around 70% of the exposure is already in large caps. So if you are getting that similar kind of exposure in another category of fund, I mean, it's good enough. You don't need to have another flexi cap
fund. We move on, and we move on to our next question, which is from Nagesh, and he wants to know which is the best small cap. He's currently invested in Axis Small Cap, SBI Small Cap, and PGIM Small Cap, and the returns are almost the same. He wants to exit, and if at all he decides to do, which fund should he be exiting?
See, again, it's a question of how you are looking at the portfolio and composition and how its construction, because one has to understand the category where one is investing into. The small cap category consists of actually and more than a few thousand stocks, because anything which is beyond 250 in terms of market cap actually falls into the small cap category. Now, when a fund has such a wide area in terms of choice for its portfolio, it becomes very difficult for someone to pinpoint a particular fund and say that this is one which is either going to do well or is going to consistently do well also. So in that sense, there is likely to be several funds which keep doing well at different points of time based on what kind of exact holdings that they have. So that is one thing. The other point is that, see, having so many small cap funds might look like a good strategy, but if these are the only funds in the portfolio, then it makes for a bad strategy, because I mean, having too much of high exposure to just a particular part of the equity market is not smart. It requires an exposure to large caps to bring stability into the portfolio. So that if this is the only holdings in the portfolio, then this kind of exposure to only small caps needs to be reviewed. The third part, which is that if there is a specific question in terms of if there are these three funds which are virtually giving you a similar kind of return, then which is the one to exit from, Axis would be the choice, given the nature of the question.
All right. Thank you so much for being on the show, helping our viewers with their financial portfolio today, Arnav. And on that note, we sign off, and I'm going to leave you with our WhatsApp number and email ID where you can send us your financial portfolio queries. Thank you so much for watching. Goodbye.
Great news for those who want